Well, as we had expected, the Reserve Bank cut interest rates today. So they cut the overnight cash rate from 25 basis points to 10 points, the 3-year targeted bond rate from 25 basis points to 10 points, and the rate on new drawings of term funding facilities from 25 basis points to 10 points. All of those rate cuts were expected. There was some controversy on what they would do on the exchange settlement account rate. That's the rate that banks are paid by the Reserve Bank when they deposit their funds with the Reserve Bank. Market was thinking around 5 basis points, down from the 10 before. We thought it'd be 1 basis point, and we were surprised that they actually set it at 0. Of course, the other big speculation was around the quantitative easing policy, and the Reserve Bank announced today that they would be purchasing $100 billion of 5 to 10-year bonds between now and June next year. That's around $5 billion per week, $4 billion of which will be Australian government securities and $1 billion will be semi-government securities. They've also indicated that that allocation of $100 billion will not go against the money needed to defend the 3-year bond target. So that will be additional purchases, although of course they haven't put a number on that. That's quite a neat way of getting around a problem that I thought they would have in terms of setting both a quantity and a price. And of course what they've done is they've set a price for one part of the yield curve and a quantity for the other part of the yield curve. There was some speculation that they might target the 5-year bond rate as well, but the governor indicated that targeting the 5-year bond rate at the cash rate would indicate they expected that cash rate to stay at 0.1 for 5 years, and that was too big an ask. That they expected that the economy would be improving to a point where it wasn't realistic to think that the cash rate would stay at 10 basis points for that longer period. And I certainly agree with that. The objective behind getting the bond rates down is not only to boost the economy, but is also to put some downward pressure on the currency. The governor's view was that international investors were attracted to Australia's high bond rates, and if the bond rate was reduced, then that would become less attractive, bringing in less capital. The bond market responded to these policies. Because they were a little more aggressive than expected, the bond rates came off a touch and the yield curve flattened, in the sense that because all the purchasing targeting will be at the long end of the curve, those bond rates came down. Well, what does this mean in terms of the Reserve Bank's balance sheet? Well, before COVID, the Reserve Bank's balance sheet was $180 billion. That has since grown to $300 billion. There's outstanding term funding facilities of around $104 billion, and I expect that to increase up to around $130 or $140 billion. They've now committed to $100 billion in bond purchases, and of course there will be additional money required to defend the 3-year bond target. So let's say that the balance sheet will be up at around $550 billion by June next year. That's an increase of around 3 times over that since COVID, and it'll push the balance sheet to 27.5% of GDP. So think of that in terms of the US Federal Reserve. US Federal Reserve balance sheet is around 33% of GDP, and since COVID it's increased by around 85%. So the Reserve Bank's been a late starter to the game, but they've certainly become quite aggressive. So why did they pick $100 billion? Well, the governor's indicated that their research on the activities of other central banks have suggested that 5% of GDP, of which $100 billion is for Australia, is going to have an impact. And that's why they chose that $100 billion. But of course it neatly fits in with the expansion in the balance sheet, but not quite getting to that 30% of GDP level that we've seen, which is very close to the Fed's level. So the choice of that 0 exchange settlement account rate was also interesting, because in this market there's an excessive amount of liquidity. So banks often have no choice but to lodge their funds with the Reserve Bank. Now when that rate was 10 basis points, that was quite attractive. And if a corporate or a large institution wanted to deposit money with the bank, then the banks could re-lodge that money at 10 basis points with the Reserve Bank. But if the Reserve Bank rate is 0 and we have these ongoing extremely liquid conditions, and corporates or institutions want to deposit money with banks, it raises the spectre that interest rates may go negative right at the very low end of the yield curve. Banks will have to decide on whether they offer negative deposit rates to these institutions and large corporates. And of course, they'll have to weigh that against long-term relationships. Of course, we've said that that would lead to potentially lead to negative interest rates at the very short end of the curve. Does that mean the Reserve Bank is embracing negative interest rates? No, the Governor confirmed once again that negative policy rates would be extraordinarily unlikely. And once again, he said the main reason for that was that it would distort the credit creation process. However, he also pointed out that one thing that might change that would be if the big central banks around the world went negative themselves. Well, with the ECB and the Bank of Japan already there, all eyes are on the Federal Reserve. Now, we don't think the Federal Reserve is attracted to negative rates, but the Fed going negative would be a major signal to the RBA that they may have to follow. But note that he said the major central banks. So we've heard some flirtation with negative rates from New Zealand, the Bank of England, and the Bank of Canada. I don't think they would fit into that category. It would be very much about the Federal Reserve. The Governor also released some revised forecasts for growth. So they now expect growth in the year to June next year to be 6% and in the year to June 2022 to be 4%. We released our estimates of what they'd be forecasting last week. We thought that that 6% was going to be about 5.5% and that 4% was going to be 3.5%. So indeed, they've significantly raised their growth forecasts and in fact a little more than I was expecting. He also released some unemployment forecasts indicating that he thought that the unemployment rate that they used to think was going to be 10% by the end of the year will now be slightly below 8%, and that's about what we expected. He also said that by the end of 2022, the unemployment rate will be down to 6%. We're expecting about 6.5%, so once again, a little more optimistic than I was expecting. But of course, 6% is still not good enough, and that of course is the reason why he's comfortable to maintain that 3-year bond target at the cash rate. So in conclusion, a more aggressive approach to quantitative easing than I expected, and the bond market has responded appropriately, and a very much more upbeat commentary that we have the capacity to do more, and if necessary, we will do more, and the major variable that will determine that will be the unemployment rate. Thank you.